please make sure that you have attempted this question under exam conditions before watching the recording. So we've got 15 minutes to work through the information provided in the scenario, so let's start with that. Office Chair Solutions, or OCS, are designers, manufacturers and distributors of quality office chairs to both the private and public business sectors. From humble beginnings in 2003, OCS has grown from a small, independently owned business into a well-established Level 2 Black & Powered company with offices in Johannesburg and Cape Town. OCS offers customers the choice between an executive chair and a classic chair. Alright, so we're dealing with two different products. The executive chair is upholstered in Italian leather and is highly adjustable to ensure lasting comfort, creating a more productive and pleasant working environment. Leather is imported in batches of 800 square meters at a cost of 1.4 million rand per order. Delivery fees and non-refundable import duties amount to 280,000 rand per order, and each chair requires 2 square meters of leather. Alright, so let's just make sense of the information that we've been provided with. Firstly, we know that the chair is upholstered in Italian leather. So the leather is going to be a direct material cost, and it's going to be a variable cost. The cost per unit should remain constant, and the cost in total should vary with the number of units produced. And obviously that is going to be a product cost. Remember, it's important to distinguish between product costs and period costs. Product costs are manufacturing related costs that we are allowed to include in the value of inventory. On the other hand, period costs are not manufacturing related costs. It includes things like marketing, admin and selling costs, and we never include period costs in the value of inventory. Period costs are expensed in the period incurred. So it's important to be able to identify what is a product cost that we include in the value of inventory and what is a period cost that we expense in the period incurred. Then we also have delivery fees and non-refundable import duties. And guys, in terms of IAS 2, this cost should be included in the value of inventory. Alright, then next we are given information relating to the classic chair. The classic chair is upholstered in fabric and is best suited to heavy-duty environments where the chairs are continually in use. They are less adjustable, smaller, and easier to maneuver than the executive chair. Each chair requires 1.5 square meters of fabric at a cost of 500 Rand per square meter. Alright, so once again over here we've got fabric, which is used to produce the classic chair, so that's going to be the direct material. Once again, this is a variable cost. The cost per unit remains constant, and the cost in total will vary with the number of units produced. And once again, this is a product cost. It is a cost that we are allowed to include in the value of inventory because it is manufacturing related. Other direct material costs amount to 1,200 Rand for a single executive chair and 750 Rand for a single classic chair. Direct labour is paid at a rate of 50 Rand per hour. An executive chair requires 210 minutes and a classic chair requires 150 minutes to manufacture. Alright, so we've got two other costs over here. We've got other direct material costs and we have direct labour. So once again here guys, the direct material cost is going to be a variable cost, and it is also a product cost because it is direct material, exactly the same as the leather and the fabric that we looked at above. And then for direct labour, remember with labour you can't just always assume that the cost is variable, because especially in an environment like South Africa where you can't just, if production volumes decrease, you can't just get rid of your employees, and then when production volumes increase, get your employees back again. It doesn't work like that. You normally have to pay your employees regardless because they are full-time employees. So in reality, labor is most likely going to be a fixed cost. However, you will remember, if we are dealing with direct labor, it's safe to assume that the cost is variable. All right, so this is a variable cost, and once again, it is also a product cost, which we are allowed to include in the value of inventory. Then we also have the total annual manufacturing overhead cost, which excludes depreciation, has been estimated as follows. So you can see you've been given the cost and also the corresponding machine hours. Now guys, this is the total annual manufacturing overhead. So it's the total manufacturing overhead, meaning it includes both fixed and variable manufacturing overheads, which means it is a semi-variable cost. And remember, we can't work with semi-variable costs. If you are given a semi-variable cost, you need to split it into its fixed and variable portions before we can perform any calculations. So we are going to have to split this cost. And based on the information that's been provided over here, we'll be able to split this cost using the high-low method. How do I know that I can use the high-low method to split the cost? Because I've been given various different costs and various different output levels. So I'm going to pick the high and the low output level with the corresponding high and low cost, and I'm going to split this cost into its fixed and variable elements. All right, then just below we are given information relating to depreciation on factory buildings and machines, which amounts to 252,000 Rand per annum. Now that's important because we know the manufacturing overhead cost above excludes depreciation. So you've been given the depreciation separately. OCS has adopted an absorption costing system. So remember, if they are using absorption costing, that means that they include both variable and fixed manufacturing costs in the value of inventory. So if we go up, we said that this total annual manufacturing overhead is a semi-variable cost, and we are going to split it into its fixed and variable portions using the high-low method. The variable manufacturing overhead is obviously a variable cost, that's self-explanatory, and it's a product cost which is going to be included in the value of inventory because it's manufacturing related. And the fixed manufacturing overhead is obviously a fixed cost, also self-explanatory over there, and because the company uses absorption costing, this cost is also going to be included in the value of inventory. So it is a product cost. Then we didn't do this for depreciation, so let's also just do this for the depreciation expense. This is going to be a fixed cost. The cost is 252,000 per annum, regardless of the number of units that are manufactured. So we are dealing with a fixed cost over there. And now just be careful, guys, because depreciation can either be a product cost or a period cost. If we are talking about depreciation on computers, office equipment, office furniture, etc., that has got nothing to do with manufacturing. So that is a period cost that will be expensed in the period incurred. However, this is depreciation on factory buildings and machines. So this is manufacturing related. This is going to be a product cost that we need to include in the value of inventory. All right, so we know that they've adopted an absorption costing system, and you are told that they currently use machine hours to allocate fixed manufacturing overheads to products. Normal capacity is 28,000 machine hours per annum. All right, so remember, if we want to calculate the allocation rate, we are going to take the budgeted fixed manufacturing overhead and we are going to divide by normal capacity. That's in terms of IAS 2, and you have been given normal capacity at 28,000 machine hours per annum. An executive chair requires 5 machine hours to manufacture, while a classic chair requires 4 machine hours. Administrative costs amount to 80,000 Rand per month, and selling costs are 5% of revenue. All right, so both of these costs over here are going to be period costs. They've got nothing to do with manufacturing, so we don't include them in the value of inventory. They are going to be expensed in the period incurred. The admin costs are 80,000 Rand per month, so just be careful. You've been given that cost per month. If you need the annual cost, you're going to have to multiply that by 12. And that is going to be a fixed cost. You can see it doesn't vary with the number of units produced or the number of units sold. It's a fixed cost of 80,000 Rand per month. The selling costs, on the other hand, are 5% of revenue. So selling costs are going to vary depending on revenue. So that is going to be a variable cost. And it's also a period cost. OCS expects to sell 1,800 executive chairs and 5,400 classic chairs during the upcoming financial year. Selling prices are calculated based on a 60% markup on prime cost. All right, so we obviously need to know what prime cost is, otherwise we won't be able to calculate the selling prices. So guys, remember your prime cost is the direct material cost plus direct labor. So they take that prime cost, they add a markup of 60% in order to get their selling prices. And they do not hold any inventory of finished products, meaning that production volumes will equal sales volumes. So we haven't been given the production volumes over here, but we have been given the sales volumes. We know that they expect to sell 1,800 executive chairs and 5,400 classic chairs. So if they don't hold any inventory of finished products, they're also going to have to produce 1,800 executive chairs and 5,400 classic chairs. So that's important. All right, then on the next page, we've been given the break-even point calculation that's been prepared by the junior accountant. All right, so remember, how do we calculate the break-even point in units? We take total fixed costs and we divide by the contribution per unit. However, we know that OCS has 2 different products, and whenever we are calculating the break-even point and there's more than one product, we need to calculate a weighted contribution per unit. So instead of just dividing by a contribution per unit, we are going to divide by the weighted contribution per unit. And please remember, guys, the contribution per unit is just the selling price per unit minus the variable costs per unit. So the reason why I write down the formula is that then helps us make sense of this calculation over here. We know in order to calculate the break-even point, he's going to have to calculate total fixed costs. He's going to need the selling price per unit and the variable cost per unit for both products so that we can calculate the weighted contribution per unit. All right, now at this point, we don't yet know what the required is actually going to ask. So I don't want to go through this in too much detail. We're just going to look at this at a high level. When we get to the required and we see what's actually asked, then obviously we'll look at this in a lot more detail. So you can see first he's calculating fixed costs because he obviously needs the fixed costs over there for that part of the formula. Then after that, he's calculating the selling price per unit because he needs the selling price per unit for that part of the formula. And remember, on the previous page, we were told that selling prices are calculated based on a 60% markup on prime cost. So first he has to calculate the prime cost, which is direct material and direct labor costs. So you can see he is doing that. He calculates the prime cost. He then adds a markup of 60% to get the selling price per unit. Then once he has the selling price per unit, he uses that to calculate the contribution per unit. And remember, the contribution per unit is just the selling price per unit minus all of the variable costs. Then after that, he calculates an average contribution per unit. So he adds these two together and divides by 2 to get an average contribution per unit. Now, already we know that's incorrect because you shouldn't just calculate an average. You should calculate a weighted average. we divide by the weighted average contribution per unit. And you calculate that weighted average by using the expected sales mix of the company. We don't just divide by 2 and calculate an average. And then he calculates the break-even point by taking the total fixed costs, dividing by that average contribution per unit, and he gets the break-even point in total for OCS. All right, guys, and you can see he has also correctly rounded up over here to the nearest whole number. Remember, you always need to round up. If you round down, then the company won't break even, they'll make a small loss. So you need to round up to make sure that they actually break even. So he has done that over there correctly. But there's quite a few problems in this calculation, which we will see when we look at it in a bit more detail. All right, but for now, that's all of the information that we've been provided with in the scenario.